Your credit card is not just a payment tool. It is a behavioral machine disguised as convenience. It lives in your wallet pretending to be freedom, then sends a statement where the magic trick ends. One swipe looks simple. Underneath, cardholder, merchant, bank, processor, network, and credit bureau all wake up. In Q1 2026, US household debt reached $18.8 trillion. The matrix is not small. Credit cards are special because they revolve. The balance can survive month after month, payment after payment. Federal Reserve data showed consumer credit rising at a 3.2% annual rate in Q1 2026, while revolving credit rose 3.8%. The system does not need a villain. It has incentives, fees, interest, interchange, risk pricing, and balances that stay alive. The first trap is psychological. The pleasure happens now, but the pain arrives later. That gap changes behavior. Cash hurts immediately. Credit hurts later. And later is where expensive decisions go to hide. The minimum payment is brilliant because it makes a dangerous balance feel temporarily manageable. Current does not mean free. The trap begins when a payment tool becomes a debt. Subscription. The card stays useful, but the balance starts owning you. Rewards feel like winning, but 2% cashback. Loses badly if you pay 21% interest. A credit score can be a key, but the key often opens a door to more credit, not more wealth. The exit is not motivation. It is a system. Stop new. Debt, measure balances, automate minimums, attack principle. First, we map the system behind one swipe, because the card is only the interface. The incentives are the machine. One swipe is not one event. It is a tiny financial parade where everyone has a different reason to smile. For the cardholder, the swipe feels like spending, without losing cash today. That is the first illusion. For the merchant, the card can bring the sale, but the sale arrives with processing costs attached. The issuing bank gave the credit line. If you carry a balance, this node can turn old purchases into interest revenue. The acquiring side helps the merchant accept the card, receive funds. Invisible plumbing, very visible economics. The processor and network route the message. Is this account valid? Is there credit available? And should the sale be approved? Approval is not emotion. It is a rule engine checking. Credit line, account status, fraud signals, and merchant request. The merchant discount fee can include interchange, network assessment, and acquiring fees. The customer sees a receipt. The system sees slices. Interchange is one reason issuers can fund rewards, fraud, systems, credit risk, and the business of extending credit. Rewards are not fake, but rewards also train. Attention. Focus on points, not total cost. The credit bureau does not watch your intentions. It watches behavior, payments, balances, utilization, and account history. A higher limit can help utilization, but it can also trick your brain. Available credit is not available money. The beep is instant, but the back office keeps moving. Authorization, clearing, settlement, and accounting. Every node has an incentive. Approve, sell, route, record, reward, charge fees, or earn interest if the balance survives. Now that the payment network is visible, we can see the deeper machine, your own brain under a checkout button. The credit card matrix works because your brain is not a spreadsheet. It is a dopamine machine with a calendar problem. A credit card separates the pleasure of buying from the pain of paying. That delay is not neutral. It changes behavior. Cash hurts now. Debit hurts soon. Credit often hurts later. And later is where your budget goes to negotiate badly. The purchase says, enjoy today. The statement says, remember me? The due date says, choose your future. Mental accounting sounds like this. Future me will pay. Unfortunately, future you has rent, groceries, and a face. The minimum payment is an anchor. It tells your brain the debt is smaller than it really is. A small payment due can make a large balance feel civilized. But civilized debt still charges interest. Minimum payments can keep the account current while interest keeps the balance alive. Current is not the same as escaping. Frictionless checkout is convenient. But when spending becomes effortless, restraint has to work overtime. Small recurring charges are dangerous because each one feels harmless. The total is where the trap stops being cute. Rewards create a tiny victory feeling, but a tiny victory can distract you from a large balance. The brain negotiates like a tiny lawyer. I deserve it. It was on sale. The points make it smart. Very suspicious lawyer. Lifestyle creep rarely feels like one huge mistake. It feels like many small upgrades wearing a normal life costume. Then life happens, with no cash buffer. The credit card stops being convenience and becomes survival debt. The behavioral firewall is simple. Add friction, build. Cash, pay in full. Next, we open the bank profit machine. Now we open the bank profit machine, not to scream conspiracy, but to understand incentives with the lights on. A card account can create revenue through multiple pipes. Interchange, interest, late fees, annual fees, transfers, and cash advances. In February 2026, commercial bank credit card accounts assessed. Interest were around 21.52%. That is not background noise. A $5,000 revolving balance at 21.52% APR can generate roughly $90 of first-month interest before new purchases. When interest takes a big slice of the payment, less money. A tax principle. The account survives. The balance limps down. A current account can still be expensive. Paying on. Time avoids one problem, but carrying debt creates another. In 2022, CFPB reported credit card companies charged consumers more than $105 billion in interest and more than $25 billion in fees. Late fees are not just annoying. They can raise the balance, create stress, and sometimes start a worse chain reaction. CFPB said late fees cost American families more than $14 billion a year. Fees are small individually, enormous collectively. Missed payments can trigger fees, penalty pricing, and credit damage. Automation is boring because boring works. Annual fees can make sense only if the benefits beat the cost. But interest can erase the perks like a financial leaf blower. Risk pricing means the lender adjusts terms based on expected danger, utilization, payment history, delinquencies, and credit profile. The issuer also has costs: fraud systems, operations, rewards, funding, customer service, and losses when borrowers default. Same card, different outcome. Paid in full is a tool. Revolving balance is the subscription the machine loves. Next, we enter the minimum payment maze, where a tiny number can make expensive debt feel strangely polite. The minimum payment is not evil. It keeps you current. But current is not the same thing as free. Your statement already hints at the trap. Pay only the minimum, and payoff can take longer with more interest. The maze has 4 controls: balance, APR, payment, amount, and whether you keep adding new purchases. At 21.52% APR, a $5,000 balance can create about $90 of first-month interest before new purchases. Your payment does not magically erase the balance. First, interest gets fed, then principal gets whatever is left. Simplified, $150 a month may take around 51 months. $250 may take around 25. Extra principal changes the maze. When the minimum shrinks as the balance falls, the maze can stretch. A fixed extra payment keeps pressure on principal. New purchases are the maze reset button, paying down debt, while adding more is climbing an escalator the wrong way. The first escape rule is boring and powerful. Stop adding new debt before you optimize the payoff strategy. Then list every balance, APR, minimum payment, and due date. You cannot defeat a maze you refuse to map. Avalanche is math first. Pay minimums on everything, then throw extra principal at the highest APR balance. Snowball is psychology first. Attack the smallest balance to create a quick win and momentum. Avalanche saves more interest. Snowball may save your leg. Motivation. The best plan is the one you actually follow. Automate minimums to prevent late fees. Then, manually attack. The target balance with extra principal. Boring is beautiful. Next, we enter the rewards casino, where points feel like profit until interest walks in with a flamethrower. Rewards are not fake, but rewards turn spending into a game, and games are very good at training humans. Points create a tiny victory, but the spending meter is usually quieter than the celebration animation. 2% cashback is useful only if you avoid paying 21% interest. Otherwise, the math brings a shovel. Sign-up bonuses can be valuable, but a spending target can turn unnecessary purchases into a mission. Category multipliers are fun until you buy things to fit the category instead of using the category for things you already needed. Optimization can become a second job. At some point, the points are managing you. CFPB complaint themes include unexpected conditions, devaluation, redemption problems, and rewards being revoked or canceled. A point is not cash. Its value depends on rules, redemption options, and whether the program changes the math. The reward is only useful if you can actually redeem it at a value you understand before the rules change. The rule is simple. Rewards are a game only, after the statement balance is paid in full. A disciplined user does not spend because of rewards. They collect rewards on spending that already passed the budget. Same points, different outcome. If rewards trigger spending, they are bait. If they follow a plan, they are a bonus. Use a harsh rule. No revolving balance, no interest, no unnecessary spending, and no reward too complex to explain. Rewards can expire, change, or disappear under terms you forgot existed. Treat them as coupons, not wealth. Next, the credit score cage, the number that can open doors, but can also make debt feel like progress. A credit score can be a key, but a key is not wealth, and sometimes the door opens into more debt. A credit score is a prediction model, not a morality score. It tries to estimate how likely you are to repay. Most scoring systems care about patterns, payment, history, amounts owed, credit age, new credit, and credit mix. Payment history is the big one. On-time payments build trust. Missed payments can echo for a long time. Autopay minimums protect the score. Manual extra. Payments attack the debt. Do not confuse the two jobs. Utilization is simple. Balance divided by credit limit. 3,000 on a 10,000 limit equals 30%. High utilization tells lenders you may be close to maxed out. The model sees pressure, even if you feel normal. Available credit is not available money. It is available debt with a very friendly interface. A higher limit can lower utilization if spending stays. Still, if spending rises too, the cage simply gets bigger. A high score can help you borrow. It does not prove you are wealthy. Credit score is not net worth. Scores can open doors, loans, rentals, insurance, credit limits. But access is not the same as progress. New credit is not forbidden, but random. Applications can create noise. Apply with purpose, not boredom. Credit mix can matter, but do not borrow money just to decorate a score model. That is expensive interior design. Review your credit reports. The model uses data, and bad data can become expensive fiction. Next, the crisis spiral. When one emergency turns a useful card into survival debt. Credit card debt often does not explode when life is normal. It explodes when life breaks. Most spirals start inside a normal month. Rent, groceries, utilities, transport, and a tiny leftover pretending to be a cushion. Then one bill lands. An $800 repair does not care that your budget was emotionally balanced. The card solves the emergency today. But if cash does not recover, the emergency becomes revolving debt tomorrow. The balance rises, utilization jumps, and the credit model starts seeing pressure even before your emotions catch up. Next month, the minimum payment is bigger. The budget has less oxygen. The spiral now has momentum. If the payment arrives late, the problem can multiply. Fees, interest consequences, and possible credit damage. In Q1 2026, 4.8% of outstanding debt was in some stage of delinquency. Credit card early delinquency transitions were 8.6% annualized. The spiral is not proof that people are stupid. Often, it is proof that the household had no firewall. A cash buffer is not exciting. It is a firewall between a bad day and a revolving balance. Start small if you must. $250, $500, $1,000. The first buffer is not wealth, it is breathing room. If you are already in the spiral, triage first. Essentials, minimums, issuer call, fee waiver request, hardship options, qualified help. Ask early, not after the account is on fire. Some issuers may offer options, but avoid miracle debt relief promises. Recovery is a system. Pause new charges, rebuild buffer, automate protection, attack principal, and remove the triggers. Next, the escape plan. Not motivational quotes, but a step-by-step operating system for getting out. Escaping the credit card matrix does not start with motivation. Motivation expires. Systems remain. Step 1. Stop new debt. You cannot drain the bathtub while the faucet is still running. Step 2. Add up income and expenses. Not emotionally, mechanically. Find the dollars that can attack principal. Step 3. List every card. Balance, APR, minimum payment, due date, and status. Name the monster. Avalanche is the highest interest method. Pay minimums. Everywhere. Then put extra money on the highest APR first. Snowball is the motivation method. Pay minimums everywhere. Then eliminate the smallest balance first for a quick win. Do not argue online forever. Avalanche saves interest. Snowball builds momentum. Choose the one you will actually follow. Automate minimum payments to protect yourself from late fees, then manually attack the target balance with extra principal. If you cannot pay, call early. Explain why, what you can afford, and ask about lower APR, fee waivers, or hardship options. A nonprofit credit counselor may help organize a debt management plan, often with lower payments, interest, or fees. Verify carefully. Avoid miracle debt relief promises. Upfront fees, guarantees, and pressure tactics are red flags, not rescue ropes. Build a starter buffer while paying down debt. Even a small cushion can stop the next emergency from resetting the maze. After payoff, the operating rule is simple. Use the card only when the statement balance can be paid in full. Then review weekly. Balances, transactions, upcoming bills, buffer, payoff progress, and the triggers that restart the loop. Final chapter. Leaving the matrix means changing the role of the card from lifestyle subsidy back into payment tool. Leaving the matrix does not mean hating credit cards. It means changing their job description. A card should be a payment tool, not a lifestyle. Subsidy, not an emergency fund, not a second paycheck. Rule 1. If you cannot pay the statement, balance in full, the purchase is not affordable yet. Rule 2. Automate protection, then manually review. Automation prevents accidents, review prevents drift. Rule 3. Keep utilization low. A credit limit is a guardrail, not an invitation. Rule 4. Build cash. Without cash, the card becomes the emergency fund, and the emergency becomes interest. Rule 5. Rewards come after discipline. Never chase. Points while carrying a balance. That is coupon math on fire. Rule 6. Remove triggers. Do not rely on heroic willpower against systems designed to be frictionless. Build a monthly operating system. Budget, spending cap, statement date, due date, payoff goal, buffer, and review. The matrix is delayed pain, minimums, rewards, utilization, emergencies. The exit is pay in full systems, cash, and principal attack. Same person, same card, different system. The difference is not magic. It is rules, cash, and consistency. Credit is a tool. Revolving debt is the subscription the system loves. Your job is to cancel the subscription. Pay in full, keep utilization low, build cash, ignore. Reward bait, review reports and ask for help early. Do not let today borrow from tomorrow without a plan. That is how convenience becomes a cage. This video is educational only, not financial, legal, tax, or credit. Counseling advice. For serious debt, consult qualified professionals.